We got another blockbuster IPO, this time Airbnb surging more than 100% in its market debut. Well, let's talk about IPOs yet again and what that means for the overall market. Well, joining me is Art Hogan. He's the Chief Market Strategist at National Securities. So, Art, I posed this question to my guest yesterday, so I have to start with you again. Whenever we hear these IPOs, like we see from Airbnb today, the first thing that comes to our mind is the dot-com boom, the dot-com bubble. How are you feeling seeing what you've seen from Airbnb today and also what we saw from DoorDash on Wednesday?
Yeah, such a great question. And it's so natural for us to think back to some of those companies that came out in 1999 and 2000 and how many there were and how a lot of them have just disappeared. And I think we're in a different place now. Companies that are coming out now, Airbnb is a great example of this, been around for 12 years, actually profitable, and a company that has done well in this pandemic economy and environment. Surprisingly, and surprising to everybody, people want to use the Airbnb service because they just don't want to go to hotels and they feel a little more comfortable about renting a place that they can clean themselves. And this is a company that's been private for a long time. So, real pent up demand for this, in an environment where a lot of technology companies have already moved. So people look at this as I'm getting in on an opportunity that hasn't been public before, and I'm going to take a shot at this. And when we look at some of the IPOs that have done well, that are pandemic darlings, if you will, then people feel like they're getting in at the grassroots of what could be, something terrific.
And sticking with this theme of market psychology, I'm wondering what does the Robinhood, let's call it Robinhood generation, do to this whole IPO process? I mean, we saw that the IPO price at $68 a share, it opened up double that, and I'm wondering if new influx of investors is making it hard for for the IPOs to be priced accurately.
Well, accurately is going to be a tough question to always ask, but I will tell you this. We had Robinhood type investors back in 99 and 2000. They were day traders then too. It's the friction to do that now is a lot less, right? There's no real fees. You're not paying commissions. You're doing it on your phone. And when you have a stock that traded, 60 million shares in its first half hour and in a 20-point range, there's a lot of room for these Robinhood type traders to get in and out and scalp a trade. So I think the initial pricing of this is largely done by institutions, the institutional demand for this IPO, and then the aftermarket when this comes to market and over the next 3 days will be dictated by where the real interest is, and then at some point in time we'll rationalize the valuation. So I would say that when we look at the IPO process, I would say yes, it's working. And indeed, if we were to say we're going to price this at $146, there wouldn't be institutional demand last night. It wouldn't look like such a great trade. So that's why we have that difference between where it actually gets priced and where it eventually trades, and where it trades today versus where it trades 2 weeks from now is going to be two completely different things.
Now, in your first answer, you said we're in a much different place than we were in 1999. So I'm wondering, are you buying into these IPOs? And I guess at large, a broader context is these tech stocks that have done so well in the year 2020.
Well, I would tell you this, and I think the way you frame the question is correct. What we were really trying to ascertain is human behavior. And will human behavior change our demand for the services provided by some of these technology companies that have exploded this year? So, for example, look at yesterday's DoorDash or dial back to a Peloton or even an Airbnb. Is the demand for what they're offering us right now driven by the fact that we can't do other things? Right. So, if I can go back to the gym, am I going to keep using my Peloton bike? If I can actually go to hotels and not need an Airbnb, is my behavior going to change on the other side of the pandemic? The same thing is true for DoorDash. If I can go to a restaurant and don't need to take food home, then maybe my behavior changes next year. So I think that's where we have to be very careful. How much of the human behavior that has changed in this pandemic goes back to normal as things start to normalize next year? And I think that's an open-ended question. I think there are certain things that have accelerated, right? I think that our consumer discretionary spending online has accelerated. We went from 0 to 10% of consumer demand going online over a 10-year period. We went from 10 to 23% over a 5-month period, and that was the last 5 months. I don't think we're going back, but I certainly think there are other trends that probably don't continue as robustly on the other side of this pandemic. And that's where I would have investors be concerned and certainly pay close attention to what they think human behavior is going to look like when we finally get everybody vaccinated.
And that leads me to my question, my final question, and it has to do with that idea of trends. I mean, taking a look at the consumers, we have DoorDash, that was a consumer related IPO. Airbnb is a consumer related IPO. And then we got the news today, jobless claims, what, at near 3 month high. At the end of the month, if Congress doesn't come up with a new stimulus plan, there are millions of Americans who are going to lose their unemployment benefits. So how do you feel about the consumer sector as an investment heading into the end of the year and into next year?
Consumer discretionary spending is clearly going to be impaired whether or not we get stimulus. And I believe we will. I believe Congress does not want to go home and tell their constituents they did nothing in terms of fiscal policy stimulus. That said, it's going to take a long while to get back to pre pandemic levels of employment. And that's going to be a major concern. The first quarter is going to be very difficult for consumer spending. So as you look at consumer discretionary type issues like the two IPOs this week and consumer spending in general, that's going to be much lower in the first quarter than it was in the second and third quarter of this year. There's just no way to get around that. Half of the people that lost their jobs at the beginning of this pandemic are still unemployed, and it's going to take a long time to get them back in the workforce.
All right, thanks for that. That is Art Hogan. He's the Chief Market Strategist at National Securities. I'm Conway G. Gittins, and this is Reuters.